Thanks very much, Mary Frances, and thanks to EY for sponsoring this webinar and the IAF for inviting me to speak today on the important topic of climate risk. I'm here in my capacity as chair of the executive committee of the IAIS, but at the same time would like to give some perspectives from my role at the UK's PRA and the Bank of England. Now, it might sound a cliche, but I believe that the way we respond to climate risk in particular, and sustainability risk more broadly, is the defining issue for our generation of humans. If we succeed, we will bequeath a safer world to future generations. If we fail, I think many of you might know the French quote that Madame de Pompadour gave to Louis XV when she declared, "Après nous, le déluge," after us, the flood. That's, I think, what we will be bestowing to future generations, a very precarious future. And that's why I think it is a defining issue for our generation, whether we will act nihilistically and selfishly, or we consider what comes next. Now, thankfully, the need for action in the area of climate risk, and specifically, is becoming a consensus view across the international community, public and private sector. And it is because action is needed now that it is much more appropriate to view climate change as an emerged rather than an emerging risk, which is the way that many of us were looking at it a few years ago. In my remarks today, I will consider the collaborative role insurers and supervisors have to play in a smooth transition to net zero by ensuring that climate risk is effectively assessed and managed. As we make this transition, it will be important to maintain an open and frank dialogue, to learn from each other as our understanding of the wide-ranging impacts of climate change become clearer and take concrete collective actions. Let me first turn to insurance companies, to insurers. Of course, your companies are in the business of identifying, measuring, and managing risk. This is what you do. These are, of course, the key skills that are necessary as society navigates climate change. And it will be important for insurance firms to take a leadership role. As a regulator and supervisor, I'm keen that insurers understand and take steps to address the significant risks that they will face on both sides of the balance sheets. There may be differences across business lines and in different geographies, but climate risk is systemic and will affect all firms to some degree. Particularly important for this audience will be the impact on assets, where transition and physical risks will both bite. While life insurers typically have well-diversified portfolios in terms of traditional risks, the systemic nature of climate risk may challenge this. First, given the widespread impacts on all economic sectors and all regions of the globe, climate risks may materialize also in traditionally safe assets, such as currently high-rated corporate or government bonds. Second, the typical long-term investment perspective taken by life insurers, investing in infrastructure projects and commercial real estate, means that the portfolios are likely to feel the full effects of climate change. For instance, an apartment block built today may need to be retrofitted in the future if it was not built to withstand the changes in the weather resulting from climate change. Insurers will need to think about these risks today to reduce the chances of investment losses tomorrow. Equally, there will be profound impacts on client assets. As owners or asset managers, insurers have a stewardship role to play. there will be pressures from society on asset owners to take investment decisions that support a climate transition, and reputational risks for those that do not. And insurers need to support clients to understand the impact on the wealth management or retirement plans, many of which will be paying benefits well beyond 2050. So clearly within the horizon, the climate risks could be crystallizing transition risks as well as physical risks, because physical risks have been crystallizing already. And we know there are material gaps in our ability to do that. For example, in 2019, in the UK, the PRA looked to stress test firms' resilience to some of these physical and transition risks by including a climate section in the insurance stress test. The main intention of the climate scenario was exploratory, to help enable the PRA to understand the market capability and to help inform the design and specification for the Bank of England's financial sector climate scenario, which I'm going to come to later. This exercise highlighted gaps in capabilities, gaps in data, and gaps in tools to evaluate the impact of climate-related scenarios on investments. Filling in these gaps should be the main focus for the industry as it looks to develop its climate stress testing capabilities further. Now turning to supervisors. Supervisors have a key role to play here. This is not only as micro-prudential supervisors, ensuring that insurers are appropriately managing their exposure to climate risks, but equally important from a macro-prudential perspective in assessing and mitigating the impact of risks across the financial system. Central to supporting this work is the need to develop new expertise to understand the evolving climate risk landscape and translate this into supervisory policies and practices. Here, the IAIS has a key role to play and to promote a globally consistent approach. Not only insurers, but also supervisors need to step up and develop climate risk expertise. As this is a relatively new field for us, the IAIS has been putting great effort into supporting our members in their response. And we do have a good toolkit. We have the ability to assess global market developments that present opportunities, challenges, and risks, to set international standards, to develop supervisory practices and mechanisms to ensure consistent implementation of standards, for instance, through capacity building. To date, our work has focused on assessing the risks of climate change and developing supervisory practices. We will continue to use these tools, but over time, we may expand the tools we use. For instance, as we discussed at our committee meeting a few days ago, by taking a closer look at whether there are gaps that need to be addressed in the IAIS's principles and standards. Let me say some words about the IAIS's macroprudential work. We are an active participant in the Financial Stability Board's climate change work, and that work, I can tell you, has gained new momentum in recent months. It's going fast. We aim to bring a specific insurance sector perspective to these discussions, while the FSB is aiming to provide an important cross-sectoral approach, as many of these risks are common across asset managers, insurers, and banks. In the IAIS, we launched a deep dive analysis on the potential financial stability implications of insurers' investment exposures to climate-related risks, and we intend to publish later this year our results as a special topic in our Global Insurance Markets report. And a number of authorities around the IAIS table are beginning to think how to assess the financial stability implications of climate. For example, in July 2019, the Bank of England announced that it would stress test the resilience of the UK's largest insurers, banks, and the financial system itself in an exercise we refer to as the Climate Biannual Exploratory Scenario. COVID delayed the implementation of this exercise. We were originally going to do it in 2020, But this year we are going ahead with a June launch date. Now, how are we going to do these stress tests? They will involve 3 different climate pathways, which will span not just 3 to 5 years, as typical financial stress test scenarios do, but decades. The 3 pathways or scenarios are institutions taking no additional policy action, leading to what Madame Pompadour said, 3 degrees plus of warming by the end of the century. Second, immediate policy action leading to net zero by 2050, and late policy action leading to a disorderly transition to net zero. By testing these scenarios, the aim is to be able to do 3 things: size the financial exposures to physical and transition risks of individual firms in the financial system, understand how firms might respond to different climate scenarios and how the business models could be affected, and improve firms' management of the financial risks from climate change. Carrying out the stress test will require firms to understand how business and households are exposed to climate risks and the actions required to manage them, prompting wider conversations about the stewardship to net zero and the opportunities of an orderly transition, as well as firms realizing the need for climate action in the economy. Turning now to the more traditional microprudential supervisory issues. At the end of last year, the IAIS consulted on an application paper on climate risk. That is a comprehensive guide to actions insurance supervisors can take to better understand and manage climate risk, as it affects, obviously, insurance firms. The paper discusses areas such as supervisory reporting, governance and risk management, investment policies and disclosures, and provides various examples of our members' experiences. Various IAIS members have already published their own guidance on how to incorporate climate risks into insurers' own risk and solvency assessment, which of course the application paper took into account. In the UK, in 2019, the PRA published a statement that sets out supervisory expectations for enhancing both banks' and insurers' approaches to managing the financial risks from climate change, which we expect them to meet by the end of this year. The intended outcome is for firms to make a strategic approach to managing climate risk, including by identifying current risks, risks that could arise in the future, and also considering how to appropriately take action in order to mitigate these risks. As part of this, and as will all other risks, the PRA are asking firms to explain how they got comfortable that they're holding sufficient regulatory capital to withstand material climate-related losses. Now, we know that data challenges make this hard, but defaulting to zero as a result is also suboptimal if risks are known to exist. We can't precisely size them because of the data gaps, but we know that they exist. As part of this, supervisor will explore how firms can use judgment to fill these data and measurement gaps. This is a relatively unexplored area, so it is important that supervisors and firms work together to explore what works and what does not. In this spirit of collaboration, the PRA will be discussing firms' approaches over coming periods. Enhanced transparency on climate risks is a critical precondition for the effective pricing of risks and appropriate market discipline. In partnership with the Sustainable Insurance Forum last February, the IAIS published a paper on the implementation of the recommendations of the Task Force in Climate-Related Disclosures, TCFD, in the insurance sector. The paper provides an overview of practices that supervisors have considered in the development of climate-related disclosure requirements. This work will support insurance supervisors as they consider what further steps need to be taken to promote effective disclosure. Our core principles for insurance supervision make it clear that insurance need to provide information on all material risks and how these risks are managed, which would include material risks from climate change. Despite that, our 2019 report found that while almost 75% of surveyed insurers expect climate change to impact the business, only 20% had taken action to implement the TCFD 11 recommendations. So in this area, we need to transition from awareness to action in this area as well. Now, I know that a concern is that we do not have yet a consistent and comparable global set of standards for disclosure. Recognizing that, last December, the IAIS welcomed the proposal by the trustees of the IFRS Foundation to establish a new sustainability standards board under the umbrella of the IFRS Foundation to contribute to the development of global sustainability standards. And the foundation now has announced that it will start with climate. And in that context, I was pleased to see the announcement that they made Monday this week that sets out a strategic direction to this work. Essentially, the intention is to be in place to announce the creation of a sustainability standard board by the end of the year, indeed in line with COP26. We think this is a good development, and we stand ready to contribute to this work. And in particular, our role is to be ready to assess whether these standards work for prudential purposes. Various IAIS members are also considering within the supervisory mandate if there is a role for insurance supervisors in supporting climate resilience and the orderly transition to a climate neutral economy. This is mainly driven from the perspective that the failure to achieve a transition to a low carbon economy and to build climate resilience may ultimately undermine the core objectives of insurance supervision. For instance, at the IAIS, we have had discussions on what role supervisors may want to play in supporting green investments and stewardship. While supervisory decisions need to be firmly risk-based and data-driven, and it is for governments to decide public policy questions on climate change, there may be matters on which supervisors can provide support or at least remove any existing barriers. For instance, in helping to address data gaps to support a better understanding of climate risks, and I've talked about what the bank is doing in that space. So, what next for the IAIS? As set out in our roadmap published in February, the IAIS recognizes that climate risk is a key strategic risk for the insurance sector. Later this year, we will set out further planned work that will be focused on activities that will support our members to meet our core objectives of policyholder protection and maintaining financial stability in the face of the unprecedented risks posed by climate change. And I did mention that the gap analysis that we're likely to start. I also have to say that it is remarkable how in 2021, everybody around the IAIS table is speaking with a single and unequivocal voice on the need to act in this space. There is consensus on this matter, complete consensus. Now, to conclude, on a note of optimism, there will be significant challenges ahead. We are witnessing significant collaboration in efforts to assess and address climate risk. The IAIS has been working closely with our implementation partners at the Sustainable Insurance Forum, Financial Stability Institute, and Access to Insurance on Climate Risk, and as I mentioned, of course, the Financial Stability Board. We also see increasing coordination and cooperation at the international level between the standard setting bodies and even the possible creation of a new one, as I mentioned, and increasingly political commitments, especially related to data gaps and disclosure ahead of key global summits, such as COP26. At the same time, we're also seeing effective collaboration within the insurance industry and between the insurance industry and insurance supervisors. I think it is only with this cooperation, if we all work together, avoid overlaps, but work together to fill the significant gaps that exist, that the financial sector community will be able to play its part in tackling this defining issue for our generation. So vanish Madame de Pompadour, after us, there will be no deluge. Thank you.